Good afternoon. The purpose of this presentation is to discuss how to invest with downside protection for growth, income, and growth and income. Disclaimer, this presentation is for educational purposes only. We're not selling anything at all. This is going to discuss number of funds and syndications and other investments. Please consult with your professional if you make any decisions to invest. And we'll mention a few of our own funds. If you're interested in those, please request private placement memorandum. They're only available to accredited investors. And past results don't guarantee future performance. A couple of words about me. I'm known as the Big Mike. Married. My name is Mike Zlotnik. I'm the Big Mike. Married with kids for 20 years. We have a great cat and live in Brooklyn, New York. Fund manager for a few funds at this point: Tempo Opportunity Fund, our Growth Fund. We have a few Legacy Fund and a new upcoming fund, Tempo Growth Fund. I had a career in software development for almost 15 years, and I've been a real estate investor since 2000 here in New York City and outside, and became full-time fund manager in 2009. My specialty is short-term bridge loans, also known as the hard money loans, and also value-add investments in equity with predictable cash flow and forced appreciation through the value-add. We do invest in many sectors: self-storage, multifamily, retail, office, distressed commercial debt, and so on. I'm at your service. You can find me at bigmikefund.com and tempofunding.com. Big Mike Fund is a landing page. Will take you, give you some options. You can navigate from there to the podcast, schedule some time to chat with me, and you can request a PPM and follow from there. I do have a podcast called Big Mike Fund Podcast. We release 2 episodes a month, and you're welcome to listen to it. And I do have a book out called How to Choose a Smart Real Estate Investment Fund. It's available on Amazon, and both in hard copy and electronically. Now let's talk a little bit about the economy today. So what is happening out there? Well, let's start with inverted yield curve. It's one of the economic derivatives or economic concepts used broadly, and it is a powerful tool to predict and project an economic recession. When the yield curve inverts, recession typically follows in the next couple of years. And we are now operating in the world of inverted yield curve. So it is likely that the economy is going to go into recession. GDP growth is slowing down. The days of the 4% plus GDP were short, and the chances are will continue to slow down GDP growth. The stimulus that the Fed can pump in the economy is becoming less and less impactful due to the size of the current economy and the debt. And over time, Fed's effectiveness will come down. So GDP is just slowing down. The Fed has started to cut rates, and that's a pretty drastic reversal to the strategy from the late 2018 into mid-2019 and second half. Fed has gone through from the plans to increase rates to neutral to very quickly loosening monetary policy, very accommodative to support the economy as they see enough data that we're likely going to hit the recession, and they're trying to support the economy. Trade war with China. So trade war with China is an ongoing, both political and economic war. I mean, we don't have a physical war with China, but we certainly have difference in economic interest and needs, And the current uncertainty is what hurts the businesses. It is not necessarily the fact that we have tariffs and some level of that protectionism, in a matter of speaking. What is important is the fact that stock market gets very nervous. The certainty in the investments slow down when capital investors and CEO of companies just don't know where things will go. And they need to adjust, they need to plan, and they can't. Big companies need time to plan. So trade war with China is certainly disruptive to the US economy. And the stock market is showing signs of significant volatility. And the reason for this is that we have a number of great years. We've had a great run, and there's a lot of uncertainty where things will go from here. And many investors are getting nervous. Stock market does well, and there's high confidence, and everything is just moving smoothly. The moment there are ripples in the water, volatility picks up, and we operate in a environment of high unpredictability and uncertainty. And many people are exiting Wall Street. They're getting concerned, nervous that the great bull run of the last 10 years will end, will go into a recession. And I don't have a crystal ball, or better to put it, my crystal ball broke a long time ago. I can't find another one for sale. And it's very hard to predict what's going to happen in the future. Will the recession be mild, or will the recession be significant? So let's talk a little bit about the stock market problems today and why people are exiting stock market. Number one, historically high price to earning ratios. People are paying top prices for the same level of income. They're overpaying essentially for these assets, assets being shares of the corporations. People continue to pay higher prices when the earnings were going up. The expectations of earnings growth supported higher prices, but now earnings growth is expected to slow down, and so the current PEs look expensive. Second thing, volatility is increasing. VIX is higher than it's been for years. It does find this complacency territory. It had found for years. Now it's showing signs that the VIX may be, and the VIX is the index, the volatility index, trading on Chicago Board of Exchange, that tracks essentially the cost to insure against S&P 500 dropping down. So volatility index is essentially an insurance policy, but the way it manifests itself when the stocks go up and down like a yo-yo, the index is up, obviously, and people getting nervous that the markets will correct its direction. The predictability of return on investment in the stock market has always been low, and it is particularly low now as expectations have dropped, and many people just want predictability, and the stock market does not provide it. The other major risk factor for the entire U.S. economy, if not global economy, is over-leveraged corporate balance sheets and the balance sheets of many governments, including U.S. government, state governments, city governments, corporate balance sheets as well. And the amount of debt is too high. So what happens when there's too much debt? Well, when the things are running well and the revenues are good, the debt service is good. But when the revenues slow down and the debt service becomes a burden, that's when people get concerned and nervous. So free cash flows of corporations and in municipal governments and state governments is very different. It's their tax revenues. As the economy slow down, the revenues will slow down, and the ability to service the debt will come down. Let's continue now and talk a little bit about bond market. What is the problem in the bond market today? Well, number one problem is very low interest rates, and they generate tiny return on investment to participants. On top of that, there's some level of risk. So actually, risk-adjusted return is even worse. US Treasuries are certainly perceived to be risk-free. They're guaranteed by the full faith and credit of the United States government. But many municipal, corporate bonds are over-leveraged, and they are not guaranteed by anything other than the ability of the borrower to pay. And some great corporations have strong balance sheets, and those bonds are probably low risk, but they're not zero risk. And there are plenty of corporations that are not as strong. And many municipalities are in financial distress due to the unfunded pensions and other liabilities. So when the economy slows down, the debt could come crushing down, and the quality of these bonds will not be perceived as high, and the prices will fall. So there's a significant risk to many of these bonds that they will decline in value when the borrower's ability to service the debt comes down. So these are the risks of two major classes of the Wall Street: the stock market and then the bond market. So capital is looking for safety in alternative investments, specifically real estate. What happens is many sophisticated, high net worth investors have access to alternative investments. Generally speaking, the broader masses don't invest in alternatives because they don't even know how to invest in alternatives. Real estate is a very simple asset class, one of the best asset classes out there. It is part of the alternatives, and many people just find it as the best way to move the risk away from the stock market and into alternative class, specifically real estate. So why real estate? Well, number one reason, I guess this is the perceived reason, excuse me. The perceived reason is the predictability of the return on investment. The real estate is predictable. You buy a building, you lease it up, you have a long-term lease, and your income or your rent roll is fairly predictable. You may have rent escalations written into the contract, into the lease contract, and your projection of what you're going to generate in terms of revenues and expenses is fairly well defined. It is predictable, easy to understand, but it's not guaranteed. Just want to make it very clear. The guaranteed, go call Bernie Madoff. He'll give you great guarantees. The point here is there are only two things guaranteed in life: death and taxes. And even when it comes to real estate, it is not guaranteed. It certainly is much more predictable than a stock market. The second reason people like real estate is the cash flows. You can get good amount of cash with a number of tax benefits, depreciation for example. You can also get cheap leverage. When you own an asset, you can get a bank mortgage and get great cash flow with conservative leverage. So all those things are benefits. Another key benefit, or at least perceived the key benefit, is downside protection. And I want to be very smart about this statement. The downside protection is a perception. It's not always there, not on every investment. There are plenty of high-risk speculative investments, and the purpose of this presentation is to discuss some of those things. But in general, well-placed real estate investments have downside protection. Depending on what they are, for example, you could be a lender. You could make a first lien mortgage and be first on a capital stack, and you have very strong downside protection if you made the loan well. So these are the key discussions. Or you own a property with a great mortgage, with conservative leverage, strong cash flows, and that creates downside protection as well. And generally speaking, real estate is perceived as a hedge against inflation. Prices of real estate assets have appreciated generally well ahead of inflation in most markets. Obviously, all markets are local, and things differ from a city to a city, from town to town. But real estate does provide a hedge against inflation. Now let's talk about the quintessential concept, real estate quadrants. And this methodology I've developed as a way to help people understand various investments in real estate have different characteristics. It's a very simple methodology. So this methodology is sort of, I call it the Main Street terms. And in the Wall Street, you hear terms such as conservative investment, moderate investment, aggressive investment. And those are absolutely fine terms, and I like them. But on Main Street, I like to use just two terms. One called investment grade, the other one is called speculative grade. 3 classes is too many. 2 is enough. So if you look at these quadrants, you see 4 quadrants. Quadrants 1, 2, 3, and 4. And you can see here on this table, the quadrant 1 is investment grade projects with cash flow focus. So they basically have 2 key characteristics. One is a good downside protection. We'll talk about what does that mean. But for now, let's classify these type of investments as projects or funds with good downside protection. The second key element is good cash flow. And we'll define what is a good cash flow. And the side effect of the good downside protection is low to moderate risk. If the risk was high, these projects would not have good downside protection. So those go together. Low to moderate risk and good downside protection, and the cash flow is what defines quadrant 1. So let me give you some examples of what falls into quadrant 1 real estate projects. So number 1 is a first lien mortgages or performing notes, investments in projects where you're not the owner, but you're a lender. You're in a first lien position. You're a senior on a capital stack. The only thing that's senior to you are real estate taxes. So your risk profile is generally low. You have fairly strong downside protection. The second subcategory of these investments that fall into quadrant 1 are conservatively leveraged equity deals with good cash flow. So these could be multifamily, this could be self-storage facilities, this could be office, but they're leveraged conservatively. They're not over-leveraged. Typically, I like to see leverage up to 70%. Some 75% leverage are acceptable in quadrant 1, but I don't like heavily leveraged project where there's 90% leverage. So the good rule of thumb is 70%, but it varies. Some strong cash flow projects can certainly afford higher leverage if the debt is fixed rate, cheap, and the project has a good debt service coverage ratio. So those are quadrant 1 deals. Let's just talk a little bit about quadrant 2, and we'll go into deeper dive in each of these quadrants as we proceed. So quadrant 2 deals, they're typically investment grade. They have good downside protection, low to moderate risk, but they have no or limited cash flow. That's the characteristic of quadrant 2. They're growth projects. So quadrant 2 is investment grade, growth focused. So what type of deals fall into quadrant 2? So some of the good examples are still first lien loans, but they're not performing at a conservative leverage point. So if you made a mortgage on a property, well, you bought a mortgage, you bought a loan, bought a note at, say, loan to value ratio of 65%, and you're pretty conservative in your underwriting, and the project is fairly strong collateral, and you bought quality note, that note creates good downside protection because you are low on the LTV stack. And there's another term used, ITV, investment to value ratio versus the loan to value ratio. It's important to differentiate. We'll talk a little bit about that in the future. But the money you put in relative to the value of the property, your investment, is at the good protection point. So that ratio is pretty healthy. Another example of a quadrant 2 deal would be moderately leveraged value add projects that have sort of a break-even cash flow as they go through their value add life cycle. So what does it mean, value add life cycle? Let's use an example of a multifamily project. So an asset was bought, or a complex was bought with below the market rate rents, and the property is aged. It does need renovations, it does need improvements, but it's full, the tenants, but they're just paying less than the market. And as units vacate, you as the owner of the property, renovate these units. And internally, externally, typically apartment complexes go through significant external innovations such as roofs, external siding, some electric plumbing, air conditioning, common areas, maybe a pool, maybe a gym, a could have other common facilities like a clubhouse. All those things add value. And then internally, units go through standard renovations. You get they get repainted, the appliances get changed, the cabinets get changed, bathrooms get modernized, flooring. So standard improvements, and these units look fresher, better appliances, and as a consequence, the rents could be increased. So these deals fall into quadrant 2 because they don't generate cash flow through the heavy value add part of the project, but they don't lose money either. That's what differentiates them, puts them in quadrant 2. They don't have high degree of risk because they can at least break even through heavy renovations. Now let's go look at quadrant 3. So quadrant 3 is a speculative grade, higher degree of risk, and a cash flow focused. So here are some examples. Second lien mortgages. They could generate good cash flow while they're performing. They could generate good yield, but they're inherently riskier because they're in second lien position, not first lien position. They have limited downside protection. Also, highly leveraged equity deals fall into this bucket. So an example, you could have a deal with 90% leverage and it's cash flowing well because the leverage is inexpensive, but the leverage is high. And if the economy turns because it's so over leveraged, the debt service coverage ratio could come under pressure. And the amount of risk is just higher due to the high leverage. Leverage works both ways. Now let's go and talk a little bit about quadrant 4 deals. So these quadrant 4 deals are speculative grade deals. They carry high degree of risk, and they're growth-focused projects. They have no cash flow. So they have limited downside protection, no cash flow, very limited cash flow. And typical examples of these projects are development, ground up, or redevelopment of an existing mall into a self-storage facility, or land speculation. You buy the land with the hope that it will go up. There could be a value add plan, entitle the land for a construction of a multifamily, but that's still speculative. And real heavy value add projects that lose money during their heavy value add construction part, they fall into this bucket. They are speculative in nature. They require cash flow reserves, and they carry higher degree of risks. All those projects fall into quadrant 4 deals. It's the one important comment. None of these quadrants is good or bad. Certainly, the safety is high in quadrant 1 and 2 than quadrant 3 and 4, but quadrant 3 and 4 investments could be viable depending on many characteristics. And in a minute, we'll cover some of those aspects. So how do you determine what quadrant a given deal falls into? That's a very profound question. Well, the answer is not easy. Some of them are pretty obvious and some of them take work. But let me just cover some of the key elements of the approach, how to determine. So we're talking about both funds and individual deals. So I'm going to cover this because there are funds that fall into quadrant 1 and some funds that fall into quadrant 2. Some funds fall into quadrant 4 and so on. The concept here is you could look at a fund or an individual deal. So if you're looking at a fund, you're looking at the portfolio and its strategy. Are most of the deals in the portfolio are quadrant 1 deals? How is the portfolio broken between different quadrants? So if you look at the fund fundamentals, what it invests in and what it's got in the portfolio, that'll give you a pretty good idea. Now let's talk a little bit about individual deals. Individual deals have life cycle, very important characteristic. You could certainly buy a fully performing, fully functional piece of real estate that does not require any life cycle. It's in great shape. But the chances are you're going to pay a full price. You're not going to have any upside, any forced appreciation. And we don't invest too many of these projects. We like projects that have value add, that have forced appreciation, that can generate strong return due to that strategy. But the projects exist out there that just are performing, then also known as the core investments. That's the term used. So part of the evaluation, what Quadrant falls into, one of the key questions is, what is the downside of this project? How does the investment is protected? And the downside protection mechanism may be first lien loan, or may be equity position with light leverage of a good mortgage from a bank, good debt service coverage ratio. That all those concepts create downside protection. It's not just one thing. There could be a combination of things. But understanding what protects the downside is the key determining factor what quadrant belongs into. Is it investment grade or speculative grade? The downside protection is what makes that differentiation. Now, cash flows helps you determine whether this is a quadrant 1 or 3 or quadrant 2 and 4. The strong cash flow projects typically will fall into quadrant 1 and 3. The quadrants, the low cash flow projects or no cash flow projects or losing money projects will fall into projects 2 and 4. Please know the difference, that there are investments that I've seen out there that look like quadrant 1 and 3, while they're in reality quadrant 2 and 4. They distribute preferred returns when they don't have the cash flows to generate that. And that's a wolf in sheep's clothing. Really important to know that distributions are not necessarily the cash flows. Sometimes project sponsors choose to distribute capital back. It's called return of capital. Investors might mistake it as distribution of the income. So just a quick side note. The other component of the looking at the given investment is what its projected ROI and what are its projected risks. Understanding the upside and understanding the risk is what helps determine where this project falls into. The second consideration is the deal or a fund structure. What is the capital stack? Are you investing in a given deal into a senior debt, or you invested into leverage equity? What is the leverage? It's important to you to know that, whether you take an investment as a lender or you take the investment as a equity holder. Because as a lender, you want the leverage to be low, and as an equity holder, you want leverage to be low. If the leverage is high, you're taking on more risk. And then the fee structure. This is profound. I see too many deals out there with well-spoken, great marketing gurus, sponsors, and they unfortunately offer terrible terms to investors. And you as an investor need to pay close attention to what is the fee structure. How's the manager compensated, and how investors make their return? And understanding that can help you determine whether you want to invest in a given deal or not. We'll talk more about the fee structure in the future chapters. Another key consideration is there enough capital to execute this strategy? So this is, again, of the most critical importance. Liquidity makes all the difference. You have a great project, but you're out of money, and you can have liquidity squeeze and you can lose the asset. So as long as the project is well capitalized, it's got reserves, that helps quite a bit. And then ability to withstand stress conditions. This is something that will help determine, is this a speculative grade project or investment grade? And then obviously what's really important is the fund manager or the sponsor of the project or the property or the project operator. What is their track record? How did their projections versus the actuals were in the past? What is the experience? How many projects similar they've done? What is their integrity? Do they do what they say, or they change their opinion 5 days a week? And then the ability to execute the strategy. All those things matter. So those things help determine what quadrant a given deal falls into. Let's keep rolling forward. So now we're going to talk a little bit about investment grade and the target ROI for each quadrant. And again, these are projections, and these are my opinions. They may be different for different projects, different market conditions, but in my experience, quadrant 1 deals, the deals we invest in, the deals we like, generally have a target ROI, say 10 to 15%, sometimes higher. We actually find good number of projects with ROI in the high teens that belong in quadrant one, high quality projects. I did put the range of 10 to 15% as an example. Just want to make it very clear. Projects or funds with that type of a target, well run, focused on quadrant one, they do exist. And the target ROI is 10 to 15%. Now, quadrant two, similarly, we're going to use for quadrant two 12 to 18%. And then for quadrant three, we're going to use 16 to 22%. And for quadrant four, we're going to use 18 to 24%. The reason it's important to have these numbers increasing, going from a quadrant to a quadrant, is because you're taking on more risk by going into speculative grade. Why would you want to ever consider investing in speculative grade projects if you're not getting a higher projected return? Very, very important consideration. Why take risk if you're not going to get more reward? That's the bottom line. So projects that take on more risk better have a higher reward, otherwise why do them? Similar consideration moving from quadrant 1 to 2 or 3 to 4. If you're taking similar amount of risk, but you're not getting compensated through the cash flow, then you should be making more money on the back end. That's why it's important to get higher return in quadrant 2 than in quadrant 1. Otherwise, again, why are you foregoing the cash flow into you taking the risk of not getting the cash flow? So all those considerations matter. So those are projected returns. And I wanted to make it very clear. These are not the numbers you're going to make. Those are projections. In a minute, we'll talk a little bit about risk and risk-adjusted return. So please keep in mind that all projects have risk. And here are some examples of the risk. And this is something that you absolutely have to pay attention to. There's construction. Here are some examples: construction risk, local government and regulation risk, occupancy risk, insufficient capital risk, environmental risk, local border economic conditions risk, shortage of capital, lack of liquidity risk, pro forma projection risk versus actuals, keyman risk, natural disaster risk, so on and so forth. Even investment grade projects have risk, but generally speaking, investment grade projects have better risk profile and they take on less risk than the speculative projects. And please remember, all investments are not guaranteed, other than maybe government bonds that pay you very low yield, but they are guaranteed by full credit and faith of the United States. So it's all about risk-adjusted return, not just the projected return. This is the most profound factor. What is a risk-adjusted return on a given investment? And why is it important? Well, number one, when you look into a lot of offering memorandums or private placement memorandums, they talk about pro forma returns. They'll talk about IRR, internal rate of return, or ROI, return on investment. But they don't tell you about the risk. You have to assess the risk associated with a given offering or a given fund. If you don't assess the risk, hey, listen, you could hope and pray the fund will work out the way they're projected. They rarely do. Most of the times, the projections are part of the marketing spiel. I really can't put it any other way. The offering documents, they help raise capital. And part of what they do is they put together very optimistic pro formas, projections of what the number's going to look like in terms of their income, in terms of their expenses, in terms of their future value, and so on and so forth. So you as an investor have to make a determination what is a risk and allocate what I call loss reserves. So a risk-adjusted return formula equals to projected return minus loss reserves. A loss reserve is a mathematical figure that adjusts for risk so that you can compute risk-adjusted return. Remember, all those things are projected. They're not guaranteed, but at least mathematically you're adjusting for the risk. Now here is a little bit of my own methodology, what I believe is appropriate, but it changes with markets, it changes with environment. So it's not true in every condition. Please be very, very conscious of this. Depending on what type of investments you do, how they're underwritten, and what markets they're in, and market conditions change. These things may change. But investment grade projects, in my methodology, with strong downside protection, typically first lien loans, lightly leveraged equity syndications with good cash flow and good debt service coverage ratio, typically need only between 1% and 3% loss reserve per year. And again, loss reserves are annualized figure. I would say on average, 1% to 2% is sufficient in this market. Future markets, the number may have to be increased, but generally pretty conservative range. You're not expecting to lose a lot of money if you make these investment grade, if you participate in these investment grade projects. And they must withstand stress test conditions of, and we'll talk a little bit about stress test in the future, but the basics of a stress test is reduce the revenues by 10% and increase expenses by 10%. What happens? Can the project still cash flow, can still survive and do well in the long run? Speculative grade investments, generally speaking, have significant loss reserves. Why? Well, because they could fall completely. You could lose all the money on these projects. So you have to assign a significant loss reserve figure to compensate for a higher degree of risk. And there is no right or wrong. There's projects with loss reserves that you could write easily over 20%. They promise you 25% return and the loss reserves over 20%. Are you really going to make strong return there? Absolutely not. So there is no right or wrong figure, but I write the projection between 5 and 20% and possibly higher, with an average projected in the 6 to 7% range for loss reserve on speculative grade projects. Market conditions vary, project-specific risks vary, and the loss reserve that you have to assign may be very different on these type of projects. But conceptually, you should always assign a higher loss reserve for speculative grade projects versus investment grade. So how does the math work? Well, let's put the math together now. So what is a risk-adjusted return on investment? So if you go into quadrant 1 and you're projecting to make 10 to 13% and your loss reserve is 1%, you simply subtract, and your risk-adjusted return in quadrant 1 is now 9 to 14%. That's a simple subtraction from your target minus the loss reserves is what your risk-adjusted target. Same for quadrant 2. You take the target, you subtract, and then you wind up with the risk-adjusted ROI in target 2, 10 to 16%. Now you go into quadrant 3. The loss reserve is higher. We're using 6% here as an example. And you adjust the projected number by loss reserves, and you wind up with target 10 to 16. And this similarly for quadrant 4. You start with 18 to 24, you subtract 6, you wind up with 12 to 18. Again, please realize this is a learning methodology. This is not exact science. So some projects might have projected return 18 to 24% in quadrant 4, but their loss reserve should be 20. You could actually lose money on the project, maybe even lose all of it. So you have to be pretty smart about it. Just understand the concept of loss reserves and risk-adjusted return. Capital stack and how there's a risk and reward. So this is as basic as it goes in real estate. When you invest in real estate, you either invest in the ownership of the property or you invest in a debt of the property. Depends what you invest in, your risk-reward ratio is very, very different. For example, if you invest in senior debt, typically it's a first lien mortgage. Generally speaking, if it's well underwritten mortgage, the risk is low. And your return potential is certainly lower than others. And if you invest in a first lien mortgage, your return is relatively low in comparison to other investments, but you're taking less risk. It's all balances out at the end of the day. Now, here's an example. Could be junior debt or preferred equity. So junior debt or preferred equity, the risk level is higher than the first lien debt for sure. So the risk is sort of medium. It's not as high as the equity, but it is not as low as first lien debt. So risk is medium and the return potential is medium. And if you invest in a joint venture equity or common equity of a real estate project, your risk level is high. And your return potential should be high, otherwise why invest? So those are very important considerations to know what you're investing into. So now let's talk a little bit about Warren Buffett and how he thinks about things. He's a great business leader. He is a successful investor as there is out there. And I use him as an example because he teaches us a number of really, really good concepts. So let's cover what Warren Buffett teaches us, or at least what I understand from his teachings. This is my understanding of Warren Buffett. Number one, he teaches you how to diversify, how to build a diversified portfolio that can withstand downward winds and can withstand the test of time. He has built a massive, massive fund. It's called Berkshire Hathaway. It is a fund, even though it is a single company, publicly traded company. It acts like a humongous fund. He's got a very broad, very diversified portfolio of many long-term assets that he's built over years. So diversification is job number one. And if you do this well, you will succeed in the long run. And Warren Buffett teaches us that. Number two thing that he teaches is pick the right people. What he does, he picks the people who run his businesses, his companies, his investments. He's picking the right people with the right integrity, with the right capability, with the right experience. So pick experienced managers or project sponsors or people who you invest with. Third concept, investments. So you have to pick your investments well. And your investments or your selection have to meet your diversification strategy. So you got to have a plan. If you don't have a plan, you don't have a strategy, you're just going to invest whatever comes across your desk. And that's not right. You need to invest with a purpose. And the purpose is your strategy. What are you trying to do? What kind of investments are you looking for? Your asset allocation. This is part of the financial planning, but it's very important to have that plan. And they got to meet your risk-reward comfort level. If you're not comfortable with quadrant 3 and 4 deals, stay out of them. It's as simple as that. Yes, they may promise you great returns, but if you don't sleep well at night, don't invest in them. You're going to have a heartache and a headache just thinking about it. So if you can't take the risk, don't invest in those type of assets. And then the fourth consideration is how much money you invest. So Warren Buffett does. He decides how much money he wants to pay for a company when he buys or what he wants to invest in an existing company. And it is all part of the overall strategy. So amount of capital you invest in, even if you love the project, but you can't overinvest. You got to maintain diversification. You got to follow your asset allocation and your strategy. So those are very, very important considerations to build a diversified, robust long-term portfolio. Now, let's talk about the key concept now. How do you invest with downside protection, especially when the economy is slowing down, we go into potential recession? Now, these concepts are even more applicable in this environment than if the economy was booming. Number one, invest in quadrants 1 and 2, focused funds or deals. Again, you could pick a fund, or you could pick an individual deal. In a moment, we'll talk about the purpose of the funds and the whole diversification strategy. But at the moment, let's just think of them as a one area. Invest with conservatively focused managers and sponsors, people you know, like, and trust. I can't stress this enough. You absolutely have to understand who you invest with, like these people. Make sure they think the way you like them to think. You trust them. They're not going to take your money and do some crazy, invest in something very speculative. They basically outline a good strategy. They have high integrity, and they're going to invest with that strategy, and they're going to be a good steward of your money. And number 3, invest in diversified funds and build your overall diversified portfolio. Diversification, as boring as it sounds, is a critical concept to a successful portfolio. So why invest in diversified funds? Why? Well, look at these pictures. Would you like to take a roller coaster ride? This is a famous roller coaster here in Brooklyn, New York. Cyclone, oldest wooden roller coaster in the country. It squeaks, it makes noises, feels like you're going to fly out of the thing. And you could throw up after a ride. So going on a roller coaster, it's for those who like that. Tastes different. Maybe you love that stuff. If you love it, great. You can take risks with individual deals, and you can take risk with quadrant 4 deals and other speculative deals. Or if you prefer smooth sailing, if you want your ride to be very bumperless, with minimal volatility up and down, you should take diversified funds because they provide good foundation, good degree of predictability and safety. Remember, none of the stuff is guaranteed, but you're making the best mathematical decision to invest in well-managed diversified funds, which will give you a foundation for a predictable, relatively safe portfolio. So here are some elements of diversification in real estate, just to give you a little bit of a flavor of that. So number one, types of investments. You can invest in self-storage facilities. You can invest in multifamily. You can invest in office. You can invest in industrial. You can invest in residential. The strategy of investment could be different. You can invest in value-added projects, or you can invest in stabilized or core assets. You can invest for income, or you can invest for growth. You can, duration is another element of diversification. You can invest for short-term, or you can invest for long-term. Location. In real estate, location. Where are you investing? What city, what town, what state, where within the city, what's happening with that area, with that specific micro market. So location in real estate is everything. Who are you investing with? Who is the project sponsor? Who is the fund manager? Who is the operator? Are you investing in equity or are you investing in debt? All those elements of diversification. So your portfolio has building blocks. We're talking about a diversified portfolio. So what are the elements of the building blocks in real estate? And there are a few basic elements. We can start all the way in the bottom, and it's called direct ownership. You could go buy a turnkey house, an investment property that you own for cash flow purposes for long term, and it is direct ownership. You can go buy a mixed-use building and rent out commercial downstairs of the storefront and a couple of apartments above that. That's a mixed-use building. And so on and so forth. You could buy a whole self-storage facility. It's a single, you're the only owner, so single ownership. Two, partnership. You take on partners. You do the same, you buy similar assets, but you have partners. And you could be tenants in common, it could be, you and your wife could be a partner. Third one is syndications. So syndications when you invest passively. So the first and second, typically you have active investment, you have some decision power, you're part of the partnership. With syndications and funds, you're passive. You're not investing and you're not actively participating. In syndication, typically there are many investors in a single asset. So a self-storage facility conversion from an old Macy's to a self-storage facility and a raised capital could be a syndication. Again, typically one property and many investors. Funds is the fourth element and on the top and probably the most important element. Funds typically have many investors and then they have many assets. So they don't invest into one, they have a broad diversified portfolio of assets they invest into. And there are many investors in the fund. So those are the building blocks of your diversification strategy. You got to think, what do you want to invest in and how your strategy built around those elements. So now we're going to talk a little bit about income investing with downside protection. So we talked about the quadrants, and here we're going to be pretty specific. And generally speaking, when you're investing for income, you're in a quadrant 1 and 3. And if you're investing for downside protection, you're really going to stick pretty much with quadrant 1. So it's going to be first lien mortgages or funds that focus on first lien debt or individual deals. It could be bridge loan or hard money loan. It could be you are the lender on a long-term basis for somebody making them a loan on their primary residence. A long-term mortgage, they can't get a traditional mortgage to a non-US citizen and you give them a private mortgage. That is an example of a quadrant 1 deal if it's well underwritten. And generally speaking, if you invest in a fund or individual deals, I don't like leverage on a fund level. What does it mean? It means the fund takes the money from investors and invests into mortgages, but it does not borrow from third party, putting its assets as collateral. Basically, the fund is only operating with the capital it's got. If things don't go well, the leverage is not going to hurt them. So no leverage on a fund level helps to reduce the risk. Now we're going to talk a little bit about conservatively leveraged equity deals with strong cash flow. So the alternative to being a lender on a property and being in first lien position is being an owner or a part owner on a property. You now borrow the money from a bank. Generally speaking, it's a long-term debt at low rates at a conservative loan-to-value ratio. On top of that, I like a fairly conservative debt service coverage ratio. DSCR stands for debt service coverage ratio. And it measures how much income you have to service the debt. And the higher the ratio, the better it is. So banks typically require a minimum of 1.2. I like when the ratio is 1.5. It means you have extra 50% more net operating income to service the debt after all the expenses. So debt service coverage ratio 1.5 makes the deal a whole lot safer. I also like the deals that can withstand a 10% stress test. 10% lower income, 10% high expenses, can at least break even, possibly make some cash flow. And if it can, that's good, that can survive stress conditions. Also, I very much like to look at the cash flow projections for years 1, 2, 3, 4, 5, not just average for 5 years, but each year at a time. I want to see a story that the cash flow is good and improving over time, and it makes sense. So again, you're investing for income. That's why you want to see the projections of the cash flow. These type of deals with these type of conditions should provide you with good predictable cash flow for many years and a safety of moderately leveraged equity deal. Now, if you're investing for growth and you want downside protection, you want to be in quadrant 2. You do not want to go in quadrant 4. The key concept here is downside protection. So if you want downside protection and you want growth, you've got to stick as much as possible with quadrant 2 deals. So what are quadrant 2 deals? Again, could be deals or funds. So we talked about those type of deals, but I do want to make sure there's no leverage again. So if you're investing in a first lien mortgage deal and it's not performing and you're foreclosing on the asset to take the asset, the project sponsor doesn't take some leverage against that. That creates risk. I like as little leverage as possible. If the deal is a good deal and you're going in at a good price and a good asset, should be able to make strong return without leverage. So quadrant 2 deals, no leverage. And also, if you're investing in a fund that is focused on quadrant 2 deals, look what's in the fund. Portfolio details matter. The fund has a bunch of quadrant 2 deals, then it's good. If it's got some quadrant 4 deals, and a lot of them, well, you got to pay attention to that. Again, quadrant 2 non-leveraged or lightly leveraged deals could work pretty well. So first lien non-performing loans at low to value ratio or investment to value ratio, generally speaking 65% or less. I do like deals 50 to 60% LTV ratio or ITV ratio, better to put it, investment to value ratio. And moderately leveraged and moderate value add projects. So we talked a little bit about their partner renovations. They don't go into high risk territory. They don't lose money like crazy. Just renovating units at a gradual pace. They're taking moderate degree of risk and they can sustain stress conditions. Those deals typically will fall in quadrant 2, even though their cash flow is limited, but they have good downside protection. And again, look at the sponsor's ability to execute value add strategy. That is consideration number 1. So if you're now looking to invest for growth and income, and with good downside protection, our flagship fund, Tempo Opportunity Fund, is one of the vehicles that utilizes the strategy, both growth and income, with fairly decent downside protection. But let's just talk a little bit about some of the examples here. So quadrant 1 deals or funds with diversified portfolio are good examples. You're looking for income and you're looking for good downside protection. So growth and income funds with a good mix, maybe 40 to 60 or 60 to 40% range between income and growth projects. Look what's in the fund. Look at the portfolio. Details matter. How well are they diversified? What kind of assets they got? How many deals they have in the quadrant 1 and 2 versus quadrant 3 and 4? And if that's a healthy mix, where majority of the deals in quadrant 1 and 2, that's a good fund that probably will work for you. But you certainly should look through the portfolio of the fund. Look at the fund history. Since inception, trailing 12 months, last quarter. Performance matters. How the fund has been operating in the recent future and since inception. Those are important consideration. Now, if you look into individual deals, you're looking at quadrant 1 deals. Again, you're looking for growth and income. You can certainly pick some quadrant 2 deals for sure. But you got to balance them out with quadrant 1 deals because you're trying to generate income and growth. So quadrant 1 moderately leveraged equity deals with good cash flow and value and light value add typically work pretty well. You can go into some moderate value add strategies. Just realize that there will be your growth investments rather than your income investments because their cash flow will be subdued during the value add part of the life cycle. Again, look at the cash flows years 1, 2, 3, 4, 5. Value add projects especially will show probably limited or lower cash flow in the years 1 and 2, and then after the value add has been executed, the cash flow should improve significantly upon stabilization after the renovations or whatever the value add strategy was. So looking at the details years 1, 2, 3, 4, 5, and more helps you understand and tells you the story. And again, please look at the sponsor or fund manager's ability to execute the strategy. That is the most important concept. If you work with great people, you'll see great results. If you work with so-so sponsors, not responsible people, not responsible managers, the results will follow. So it's simple as that. Work with competent, great people. That's the key lesson learned.